All right, let's jump right into this explainer. We're looking at a housing landscape today that is just completely different from anything we've seen in recent history. It's a year where the physical creation of homes, the financial transaction of buying them, and the ongoing challenge of protecting them are all basically crashing into each other. We are going to explore the colliding economic forces that are completely reshaping the American housing ecosystem.
So here's the million-dollar question, right? If mortgage rates are finally dropping, why on earth is housing still so insanely expensive? It's the central paradox of 2026 that we're going to unravel today. Normally, when the cost to borrow goes down, housing becomes more accessible. But right now, the traditional rules of real estate math are being completely rewritten by massive forces outside your local bank's control.
To figure out why this is happening, here is our agenda. We'll be looking at 1. The 2026 housing paradox. 2. Building under pressure. 3. The real estate rebound. 4. The insurance crisis. And finally, 5. A federal reinsurer.
Okay, kicking things off with Section 1, the 2026 housing paradox.
The friction here is honestly intense. You've got the financial cost to borrow finally easing up, but the actual physical cost to build and then protect that home are squeezing the market from both sides. It's like a classic squeeze play. Millions of people are finally seeing interest rates hit a number they can actually stomach, and they're eager to buy. But simultaneously, the real cost of the wood, the steel, the labor, and the insurance policy required to hold that mortgage are all just skyrocketing.
Moving right along to Section 2, building under pressure.
Let's take a look at how global policy actually hits your local job site. According to Skanska's reporting, international trade policies are just rapidly inflating the direct costs of essential materials. Think about it. When you have a 25% tariff on steel and aluminum, a 30% tariff on Chinese imports, and a 14.5% tariff on Canadian lumber, the builder's math gets really tough. Materials make up roughly half of a project's total direct costs, and these tariffs alone could drive overall project costs up by 5 to 10%.
But hey, it's not just about the wood and the steel, right? There's the human element. Proposed mass deportation policies could impact up to 23% of the construction workforce, and that's compounding an already existing shortfall of 450,000 workers. Skanska estimates a huge chunk of the 1.54 million construction workers in the U.S. lack permanent legal status. If those workers leave the labor pool, the competition for remaining skilled tradespeople is going to be fierce. That drives labor costs way up and pushes project schedules way out.
Now here's the absolutely wild part. Homebuilders aren't just fighting each other for scarce labor and copper wire. No, they are competing directly against a massive, incredibly well-funded surge in data center development. Thanks to the whole AI boom, tech giants are pouring billions into data centers. And guess what? They need the exact same electricians, HVAC technicians, and steel that homebuilders need. And frankly, the tech companies just have much deeper pockets, meaning residential builders are seriously struggling to secure the resources they need to build homes affordably.
All right, shifting gears to Section 3, the real estate rebound.
Despite all those building costs we just talked about, the National Association of Realtors is projecting a massive 14% jump in nationwide home sales this year. That is a staggering number when you consider the supply chain constraints. But it really just goes to show how much pent-up demand has been sitting on the sidelines over these last few years.
So what's driving this? Here's the micro story within the macro trend. Dropping interest rates just 1 percentage point to that magic 6% threshold instantly unlocks millions of prospective buyers. A 6% rate is a massive psychological and financial barrier. According to NAR economists, hitting that number brings 5.5 million households right back into the qualification zone, and that includes over 1 million renters who can finally become first-time buyers, injecting massive energy right back into the market.
You see, as life events force people to finally move, that pandemic-era inventory freeze we all felt is gradually thawing out. Lawrence Yoon over at the NAR hit the nail on the head, noting that the lock-in effect is steadily disappearing. For years, homeowners who snagged those historic 3% mortgage rates absolutely refused to sell because they didn't want to buy a new home at 7%. But, life happens. Kids, job changes, retirement, they can't wait forever. And as rates ease, all that inventory is finally trickling back onto the market.
And that brings us to a really rare, frankly bizarre pricing anomaly. Right now, because of heavy builder incentives, the typical older resale home is actually more expensive than a brand new one. Honestly, this has only happened a handful of times in the last few decades. Builders have been desperately trying to move inventory in a high-rate environment, so they've aggressively bought down mortgage rates and thrown in all sorts of incentives.
Because individual sellers of existing homes just can't offer those same massive financial perks, the new build is currently pricing out as the better deal for sure.
Which brings us to Section 4, the insurance crisis.
So you've managed to build or buy the house. Great, but now you have to protect it. And well, the average new policy premium just hit an all-time high of $1,952. And to add insult to injury, insurers have actively shifted the financial risk back to homeowners by raising average deductibles by 22%. Think about what this means for basic affordability. Home insurance now accounts for roughly 9% of a typical homeowner's monthly mortgage payment. That is literally the highest share ever recorded.
Get this. Insurers are actually using AI and drones to scrutinize properties from the sky. They are penalizing homeowners for roof age way before a roof is traditionally considered old. Carriers are absolutely no longer just taking your word for it. If your roof is between 11 and 15 years old, you are paying significantly more than someone with a newer roof, even if yours has 0 leaks. They are pricing the future risk of that roof failing directly into your premium today. No way around it.
But you know, national averages kind of hide the local pain. Perfect storms of climate risk and reconstruction costs are creating these massive geographic disparities in affordability. Take Colorado, for example. If you live there, dealing with wildfire risks and severe storms, you might be paying nearly 26% more for a new policy this year compared to last year. Where you live is increasingly determining whether you can comfortably afford to carry a mortgage, simply because the cost to insure the property is soaring locally.
We usually think of insurance crises as being triggered by massive name-brand hurricanes, right? Actually, scratch that. Last year, $42 billion in losses came just from severe thunderstorms, hail, and wind in the Midwest and Southeast. Because traditional carriers are pulling back so hard, homeowners in high-risk states are being forced into excess and surplus markets. These are essentially insurers of last resort. They don't have to follow the same state pricing regulations, meaning your premiums can be astronomically high.
Let's look at a potential macro solution in Section 5, a federal reinsurer.
So how do we fix this? Well, a proposal from the Brookings Institution suggests creating a federal reinsurer. It's essentially insurance for insurance companies, backed by the U.S. government. Think of it this way. When a massive disaster hits, your local insurance company has to pay out thousands of claims. To survive that hit, they buy their own insurance, called reinsurance. But reinsurance costs are absolutely skyrocketing due to climate risk. The idea is that a federal entity, dubbed U.S. Re, could step in to provide a stable financial backstop.
Now, this proposal requires 3 really strict principles so we don't end up with dangerous taxpayer bailouts. First, the government can't just hand out free money. They have to charge premiums that reflect the actual true risk of living in a flood zone or a fire path. Second, they must only step in where the private market completely fails. And third, they have to maintain strict credibility. We can't have developers just building recklessly in high-risk areas knowing the government will ultimately foot the bill.
By leveraging federal borrowing power, this whole concept aims to lower reinsurance costs for primary carriers. Because the federal government can borrow money at lower rates and spread that risk across the entire country over long periods of time, they can provide this financial backstop a lot cheaper than private global reinsurers can. If the primary insurance companies pay less for their reinsurance, theoretically, your monthly homeowner's premiums stop going up 25% every single year.
So, bringing it all together, what does this mean for us? We're looking at a housing market in 2026 where recovering buyer demand is just severely bottlenecked by the soaring physical and protective costs of ownership. It is an incredible web of cause and effect. Millions of buyers are so excited by 6% mortgage rates, but they're stepping into a market where builders are battling tariffs, labor shortages, and data center developers just to get basic materials. And even if they find a home, they face an insurance industry relying on drones and AI to push premiums to record highs.
So, I'll leave you with this final provocative thought. As building, buying, and protecting a home requires increasingly complex math, will the American dream of homeownership become a luxury only a few can really afford? Housing is clearly no longer just about picking a location and hoping for good interest rates. It is heavily dictated by global supply chains, tech industry expansion, and climate-driven insurance algorithms. Understanding these intersecting forces is absolutely the only way to navigate this incredibly complex 2026 market. Thanks for tuning into this explainer. We'll see you next time.